welcome to Anu's classroom. With this video, we are officially starting the last unit of MMPC 5 as per IGNOU's MBA, new MBA syllabus. Alright, this is the 16th unit. I've divided the contents of this unit into two videos so that each video is not too long. At the same time, we have enough time to cover topics which are important as well. So, in this video, by the end of this video, I hope that you will be able to understand the need for forensic accounting. What exactly is forensic accounting? What are its applications and what are the various forensic audit techniques? Forensic accounting, like our previous unit, that is human resource accounting, has been an important term and examination topic as well, because multiple times, I would say more than human resource accounting, we have seen forensic accounting related questions in the what you can say in the term and examination question paper. So let's get started. So how it all started, how forensic accounting came into being, that is first what we have to understand as managers, and as you might be thinking of even taking finance as your specialization also. So in that regard also, you should understand this. So the growth and development of accounting is linked to the growth and development of trade and commerce. As the volume of trade and commerce grew, the requirement for increased resources grew, both resources in both human as well as financial. So the proprietorship form of business gave way to partnership firms, and then they finally further transformed themselves into joint stock companies. And as these companies grew in size, what happened was that there was a need to delegate the responsibilities of running businesses into more and more hands. What happened with this delegation of authority was that there was a agency cost problem that was created. What is agency cost? It is the internal cost arising from the conflict of interest between the principal shareholders and the agents of them, that is, managers. So it is hidden, this agency cost, in the actions of managers or executives, that is us, after we complete MBA, okay, which is not aimed at maximizing the company's profit, but rather enriching themselves at the cost of the company's assets. That is agency cost. So who are equity holders? So the distinctive feature of companies is that the funds invested in companies belongs to a large number of people and financial institutions. Since the interest of a large number of people, that is stakeholders, is tied to the company, information provided by the companies in the form of annual reports or quarterly results should be true and fair and reflective of the actual state of affairs. Those are the equity holders, the true owners of the firm. So the annual reports and quarterly results are all compiled by the company by collating the information provided by managers of various constituent divisions of the company. And the verification of this information is carried out by both internal as well as external auditors based on the documentary evidence and explanations provided by the concerned divisions. At this stage, certain irregularities may start getting noticed or detected. When these irregularities are well planned, then the accounts window are getting dressed, that is, they get covered, and irregularities get carried out in collusion with the executives and supervisory managers to cover the tracks, and it becomes very difficult to track them down. See, when we talk about companies, it is not just one conspirator in any downfall or in any financial malpractice that happens in a company. It is not just one culprit. It is usually a team of people who which starts from the top management, right? Corruption. So sometimes these irregularities may be perpetuated by the promoters itself in collusion with senior managers, or even worse, collusion between senior managers, promoters, and auditors. And these normal fraudulent activities can be uncovered through regular audits. But when fraudulent activities are very complex and involve multiple accounts and divisions, then this normal audit will not be enough to catch them. And that is where forensic accounting's need arises. So, what is this forensic accounting? It is a multidisciplinary activity which involves accounting, auditing, computer forensics, investigation, and law. It involves gathering information as well as evidence which can withstand the scrutiny of a court of law. To put it simply, forensic accounting is a type of accounting that investigates financial information for potential evidence of crimes. Forensic accountants use accounting, auditing, and investigative skills to understand whether a person or company has committed financial misconduct, such as embezzlement or fraud. So, forensic accounting finds application in fraud detection and prevention. But the scope of financial forensic accounting has goes much more beyond this simple detection. Fraud detection is not simple, but it is not just fraud detection. It finds application in finding out the bankruptcy, insolvency, reorganization, computer forensic analysis, economic damage calculation, family law, financial statement misrepresentation, fraud prevention, detection and response, as well as business valuations. So, what exactly is forensic auditing? Normal financial audit confirms that the financial statements give a true and fair picture of the state of affairs of the company, and it is complied with all the cable laws and accounting policies. During the course of this audit, auditors may come across certain transactions that are not normal in nature and are not backed with sufficient documentary evidence also. So, to investigate these anomalies, we start doing a forensic audit. So, a few of the forensic auditing techniques which firms or forensic auditors undertake are testing internal controls, trend analysis, digital forensic examination, face to face interviews, full financial audits, application of Benford's law, which is a mathematical tool to determine whether the variables under study, that is, suspicious transactions, is a case of unintentional error or fraud. Theory of relative size factor, that is RSF, computer assisted auditing tools, data analysis ratios, and Bayesian ratios. Now, as managers, as students who are studying MBA, and since you have not yet decided, or you may have decided also, but first and second semesters are usually generic concepts. Learning in depth about these forensic auditing techniques and all in detail is beyond the scope of MMPC 4. But in case you are interested to know about them, let me know in the comment sections. I'll try to create a video on these topics as early as possible if I get enough requests. Okay, so that is covering the general aspects of forensic accounting. Now there is much more to this unit, and especially we have to concentrate a bit more on the aspects of fraud and fraudulent activities, which we will do in another video. So if you have made it this far, thank you very much for your attention, and I hope you liked this video and you found it useful. If you did, let us know by your likes. All right, and if you haven't yet done, consider subscribing. It is an honest request. It will help me reach more people like you and help them also in completing their MBA studies and grow our community. So all the very best for your examinations, and in case you have any doubts which are not cleared by the videos that I have put forth, please let me know in the comments. I'll try my best to clarify those as well. Until I see you in the next video, bye.